Hi, I'm Steve Butler. Over the past 30 years, my company has installed and operated over 1,000 401k plans, and I've supplied 401k participants with advice that has led to countless examples of investment success. If you know and apply the fundamentals and have some patience, successful investing is actually pretty simple. Not that long ago, a participant in a plan that we started 30 years ago said it all at an annual 401k meeting in January 2010. He said, "Steve, I did what you told me. I stayed the course and didn't freak out when the market was crashing. Now I'm back up to $2.2 million. His average contribution over that 30-year period was roughly $10,000 per year. So let's look at the investment basics that allow 401k investors to achieve higher rates of return while at the same time reducing their risk through a process known as modern portfolio theory. The first question we ask ourselves when choosing an investment mix is, when am I going to need this money? What's the time frame of my financial goal? 1 to 5 years could be a valid short-term goal for some of your 401k money if you plan to borrow soon for a major purchase like a house or a college education. This money should be invested in the lowest risk investments you're offered. You don't have time enough for the stock market to guarantee good performance. You don't want to be about to close escrow on a house and suddenly have 20% of your down payment disappear in a stock market crash. Goals longer than 5 years may be better served by stock market investing. While money market funds have averaged about 3%, the same as the rate of inflation, the stock market has averaged 7% per year better. However, the 7% better rate is not guaranteed, and it does not occur every year. For example, about every 4 years we have a 10% correction, and about every 7 years we have a 20% correction. Correction is just a euphemism for crash. Reduce risk by understanding how different styles and types of mutual funds relate to each other. 70% of any one mutual fund's performance is dependent on the stock market as a whole. You can have the smartest stock picker in the world running your mutual fund, but if the stock market is going down, there's a 70% chance that your fund will also be losing money. But the second most important influence is the style of the manager or the fund. Style breaks down into 9 possible types. Value investors are like Warren Buffett, the second richest guy in the country. He finds stocks that have value that has not been recognized yet by the stock market. He bought Coke, for example, during its darkest days after the New Coke debacle about 14 years ago, and he has since made a 40 times return on his money. Growth investors, on the other hand, don't care about value. They focus on what the stock price is doing, and they try to jump on rising bandwagons. It doesn't matter to them whether there's any actual value in the company, and internet stocks are a perfect example of the type of stock this investment approach would be buying. You can also have companies that are out of the box. Foreign mutual funds, real estate mutual funds are all examples of fund types that offer even further diversification. During different periods of an economic cycle, one of these 9 boxes will beat all the others, and 6 months later, another style will be the winner. There's no way to predict which will be the best performer. You solve that problem by putting together a mix of different fund types and styles. The composite result will be a straight line, which we refer to as the path of minimum regret. This is called modern portfolio theory, and it was developed or invented by Andrew Rudd at Berkeley about 20 years ago. It's a technique for reducing risk without having to settle for lower investment returns. Reducing risk is important because it helps you avoid one of the greatest risks that we face as investors, and that's the risk of abandoning our strategy. 2 corners of the style box illustrate the figure 8 pattern. In 1999, large cap growth funds gained 60%. Small cap value funds earned 0. In 2000, large cap growth lost 30% and small cap value gained 30%. A 60% flip-flop from one year to the next. While the rest of the boxes lost money from 2000 to 2002, small cap value and real estate gained 20% per year for the next 5 years. Why is creating a path of minimum regret called modern portfolio theory? Because before the concept was invented, conventional wisdom was that the only way to reduce risk was to time the market. This meant moving into cash when we thought the market was going down and getting back into the market when we were sure it was going back up. Why is market timing doomed to fail? Because most people don't sell out until they've already lost 20%. Then, traumatized by the loss, they don't get back in until they're sure the market is really going up. There have been 6 crashes since 1974 when the market goes up. A substantial part of the first-year rise, averaging 39% in the first 12 months following the bottom. A substantial portion of this rise will take place in the first 6 to 8 weeks. The rise starts then with a substantial initial burst that most market timers miss. As goofy as it may sound, in the early years of your 401k experience, we want the stock market to crash periodically because we are dollar cost averaging. With a $100 investment per pay period, we are buying 5 shares of a mutual fund. If the mutual fund price is $20 per share, if the market drops by 50%, our shares will drop to $10 in value, but we will now be buying 10 shares whenever we deposit our $100. Over time, the market will return to its original levels and higher. So we will have bought something at a great price that we can sell at a later date for substantially more. Dollar cost averaging is a guaranteed way to do well in the market, but few people outside their 401k plans have the discipline to do it effectively. In our 401k, however, dollar cost averaging is done automatically. It's the only way we can invest, so it has worked for millions of Americans since the early 80s. And this explains why there are many 401k millionaires across the country, according to the Wall Street Journal. A form of dollar cost averaging takes place when we periodically rebalance our investments. By stopping once a year and moving money to reconstruct what were our original percentage allocations of the different funds we use, we're forced to sell a few shares of our winners and add to the shares of our losers. It may sound counterintuitive. Why would we want to sell our winners? Because professional investors know that last year's winner tends to be a future year's loser relative to other fund types. By taking a few chips off the table from the winner and buying the loser when the price is relatively low, we're systematically buying low and selling high. That's the basic goal of any successful investor. Adopting this technique helps us to avoid the biggest mistake that amateur investors make, chasing last year's most successful fund. We often become our own worst enemies. Money earning 10% doubles every 7.2 years. Money earning 7.2% doubles every 10 years. It's coincidental, but a good fundamental to keep in mind. We can expect to earn somewhere between 7 and 10% with a diversified fund selection over longer periods of time, like 10 years. Our goal is to create more money for retirement. If the techniques offered here increase our rate of return by just 2% per year over what it otherwise might have been, the result, compounded, might be as much as 50% more money by retirement. Between now and then, adopting this mechanical approach to investment success creates peace of mind and the satisfaction of knowing that we're adopting today's most sophisticated and successful investment strategy. The so-called invisible hand, then, of market forces rewards people who can accept risk. Those who subject their money to the kind of market downdrafts that we've experienced over the past 10 years can expect to achieve higher returns in the long run than anyone who just invests in risk-free money market returns. The beauty of modern portfolio theory, as expressed in this lesson, is that it offers a way to reduce risk overall while still maintaining a collection of investments that each, individually, would be risky enough to generate the reward for that risk that will lead to higher returns over a long period of time. Diversifying, spreading your money out, and periodically rebalancing will set a stage that will allow you to someday say, I'm up to 2.2 million, or whatever your goal might be.